Guys, it looks like the BLS has quietly updated the CPI for the last 5 months. I'm going to go over this in detail in the video, but if you look at this, it looks like over the last 5 months, inflation is actually a lot higher than what was projected at the time. After FOMC and CPI, the stock market is trading in this extremely tight range, and it really looks like every single day is a battle between the bears and the bulls. And the main question that you're probably asking yourself is this rally, the one that we've had really since October 2022, sustainable? Is this the peak of the rally? Are stocks now going to drop? As you guys know, I did a video, three videos ago discussing why I sold a lot of my positions. So I'm going to give you an update on that and an update on what I think about the current markets and the current charts. Jam-packed video as always. Let's get right into it. All right, let's first start with the CPI. So as I said, the BLS had actually revised quietly what the CPI was month over month, really since August. And if you take a look at it, you'll see that every single month except for September was higher than what was reported at the time. August was 0.1, for instance. It was revised as 0.2. September, as I said, remained the same. October, 0.1% higher. November, same thing. And then December came in at negative 0.1. However, it was revised at plus 0.1. And if we take a look at the Bureau of Labor Statistics, the BLS's latest report after the last CPI, you could see those numbers now reflected here. Also important to note that this 0.5 that we've seen in January 2023, the one that was just reported on February 14th, matches a high that we saw in October and is really the highest that we've seen since June of 2022. So although the year-over-year numbers for inflation are still trending down, we continue to see some sectors that are leading to a month-over-month increase in inflation. Food, energy, medical care being some of the key ones. Really, the only significant drop is in vehicles. Now, after breaking out of this inverse head and shoulders, the market is still digesting this information. Really, the S&P 500 hovering between 4,060 and 4,200, up and down almost every day since after the FOMC on February 1st. Now, before I get into a technical analysis update of the markets, give you an update on which stocks I sold, why I sold them, whether I still believe that was a good decision or not. I just want to tell you that depending on when you're watching this Saturday, February 18th, we are doing a mastermind call. This is our popular Zoom mastermind call that we do every single month. I opened the last month up to the public. A lot of you joined because of it. A lot of you joined the academy after attending it. We are not opening this one up to the public. However, if you do want to be a part of it and you do want access to all of our trades, analysis, options, futures, stocks, shorts, etc., longs, and you want to join this call, if you're watching this before February 18th, click the link in the description. Between now and February 18th, it will get you 20% off and you will be able to join this call. We're going to be talking about how to trade retracements for highly successful setups, how to determine liquidity, a question that I always get asked, how to determine your bias, whether you're bearish or bullish, and which trades to take based off of that, and how to acquire confluence. As you know, I always say, have at least 2 reasons, preferably 3, why you're taking a trade. And then I'm going to go over all of our trade recaps, including this 700% trade that we took on an SPX put yesterday. So I'm going to go over my rationale for that, show you exactly how I traded that as well as our other trades. You don't want to miss it. Click the link in the description. Let's get right back to it. Okay, so is the stock market rally going to fizzle out? Well, I can honestly tell you that if I was to bet on it, I think that there is more downside opportunity here. Now, I don't think the stock market is going to crash. And I don't really think that the downside, from my perspective, will be confirmed unless we fall back into this inverse head and shoulders here. So if you recall, as I was saying before, the head and shoulders and inverse head and shoulders is the most reliable pattern on its face. If you just take it in isolation, not accounting for anything else, it has over an 80% confirmation rate. However, when they are broken, meaning when the inverse head and shoulders, when the price falls back into the neckline, or in the head and shoulders case, falls back up into the neckline, then the failure rate is also really high. So that is what I'm looking for in the face of uncertainty, I was okay letting go of a lot of stocks that I think have hit a valuation crunch. I think that there are so many stocks that have gone up too quick, too fast compared to the market conditions that we are in currently, especially with the fact that the CPI actually came in higher than expected. And it looks like inflation is not going away. We are also seeing Fed funds futures traders now trading, expecting a much higher Fed funds futures rate than before. And there's definitely a dislocation between the bond market and between the stock market. The stock market is trading really like that there's nothing wrong. And the bond market is now trading, showing caution, showing that, hey, the Fed actually might need to raise rates higher than expected. We should probably start believing the higher for longer. If you take a look at the CME watch tool, for instance, you could see that, for the March meeting, the projected rate is between 475 and 500. That just means between 4.75% and 5%. However, as we go along, I want you to take a look at what is the most projected Fed funds futures. If you take a look at July 2023, for instance, 5.25% to 5.5% is the majority projection for the Fed funds futures rate. And if you take a look at September, that is when it peaks out. And Fed funds futures investors or traders are betting that there will be a rate cut by the end of the year, because if you take a look at what is the prevailing projection for December, it is 5% and 5.25%. So this basically says that the Fed funds futures traders think that the rate will get up to 5.25 to 5.5% with a cut in December to 5% and 5.25%, basically believing the Fed that they will have to keep the Fed funds futures higher for longer. Right now, the Fed funds rate is 450 to 475, 4.5 to 4.75%. So that is what Fed funds futures traders are betting on at the moment. However, the stock market seems dislocated. And two adages that I go by during situations where economic uncertainty is on the horizon: don't fight the Fed, and the bond market is right a lot sooner than the stock market. And if we take a look at some rudimentary data by investment research at Nationwide, you can see that the rally that really started in October was fueled by retail investors buying a ton of calls, buying stocks, really since last summer. And institutional investors actually came into the new year in January 2023 underweight equities. And as I was saying in my previous videos, it is like a vicious cycle of institutional investors needing to put money to work, right? They're seeing the rally. They were mostly in cash. Obviously, that's not suitable for their clients for whom they're trying to make money. So now they're rushing to FOMO buy these equities. They have to put the cash to work. There were a lot of puts and short interest on some stocks, so that fueled a short squeeze as well. And then retail coming on top of that and FOMOing even some more, and that has fueled the rally really since October. But as I said before, unless earnings come in slamming out of the gate, earnings on companies such as Apple, Tesla, Microsoft, etc., all across the board, and if we get a cooler than expected CPI and the Fed is dovish, I believed that can continue the rally to at least 4,300. Now that could happen because we are around 4,160, but I don't think that I think that we got a dovish Fed on some fronts when talking about the financial conditions, but still saying that we got to keep it higher for longer. We are seeing the Fed funds futures traders betting that the Fed takes it above 5%. Earnings have been utterly terrible on mega cap stocks, Tesla aside, and the CPI came in hotter than expected. So do I think there is a ton more upside here? From my standpoint, I don't. And I was okay selling my semiconductor stocks, selling my Tesla, selling some of these stocks that really have ran up beyond what their current valuations suggest they should be, right? Like even if you take a look at the ARK ETF, I mean, ARK since December is up, almost 50%. So we are definitely in a euphoric driven rally by a lot of FOMO and squeezes, etc. But now, what is the market going to do here? And again, I mean, it could continue higher. Of course, the market can do what it wants. But for me, from a risk management standpoint, that was a time that I was okay fading the market. Plus, if we take a look at the S&P 500 earnings yield, the earnings yield is currently at around 4.5%. If you look at a 6-month treasury, you can get 5% or more on a 6-month treasury. As a matter of fact, if we take a look at the bonds and the treasuries right now, you could see that on a 6-month treasury, you can actually get 5.004. So for me, I'm okay selling those stocks and putting it in a 6-month treasury or doing what's called a bond ladder. If you guys want to know more about that, leave it in the comment section below. But that's basically my analysis for the markets currently. And the fact that CPI is coming in a little bit hotter to me is not good news. And I'm okay selling these stocks that ran up violently for cash and putting them in something safer at the moment while I wait to see what the Fed's next move is. Anyway, let me know in the comment section below what you think. Let me know in the comment section below what your plan is, what you are doing. Do you think the market will go higher? Are you a bear? Are you a bull? Why? What do you think about them revising the CPI numbers? Would love to hear from you. Join the Academy if you want access to the Mastermind call this weekend. Depending on when you're watching this, you also get access to all of the courses, the trade alerts, my analysis, etc. 20% off, only good for the next couple of days from the time that this video was launched. So check that link out in the description. Stay safe out there, traders. Peace.